Every war usually follows a script the markets already understand. Oil spikes, headlines erupt. Equities stumble, politicians deliver speeches about stability, while traders quietly position for the premium to fade. History has repeated this pattern through the Gulf War, Libya, Iraq, Syria, and Yemen. The market sells first, volatility surges. Eventually prices drift back toward the trend that existed before the first missile launched. But this time, something unusual happened. The geopolitical shock was not what truly disrupted the pattern. The real anomaly sits inside a quiet line of data published daily in the COMEX warehouse report, a number most television analysts never mention. As of March 12, 2026, registered silver in COMEX vaults stood at 79 million ounces. Registered metal is not theoretical supply or paper exposure. It is the physical silver actually eligible for delivery when a futures buyer demands the metal, and that number has been shrinking at a pace that no longer fits the historical rhythm of war-driven markets. While headlines focus on missiles and oil, a different tension is building beneath the surface of the metals market. Because when deliverable supply begins tightening during a period of geopolitical stress, the narrative investors rely on to interpret risk may start to change. Before we trace the rest of the chain, let me pause for a moment and make something very clear. In markets like this, clarity matters more than speed, and trust matters more than noise. Nothing here is being sold. No signals, no paid tiers, no private groups promising shortcuts to profits, just open analysis built on data that anyone with a browser can verify. If someone reaches out claiming to represent this work with a paid offer, block them immediately. The only purpose of conversations like this is to help you see what the broader market often overlooks. Because the reality is that information itself is not scarce, interpretation is. Every day, reports from places like the COMEX warehouse filings, the International Energy Agency, and macro research firms such as Oxford Economics quietly update the numbers that shape the global system. Yet most investors never read them. They watch headlines instead. But markets rarely move because of headlines alone. They move when underlying conditions shift in ways that force capital to reconsider where safety truly exists, and that is why building a community that actually reads the data matters. Because once you start connecting these signals together, the story unfolding across commodities, currencies, and geopolitics begins to look very different from what the surface narrative suggests. Then on February 28, 2026, the geopolitical landscape shifted in a way that instantly changed the calculations across commodity desks worldwide. The United States and Israel launched coordinated strikes against Iran, an operation that within days altered the balance of power in the region. Following the death of Ali Khamenei, his successor Mojtaba Khamenei made a decision that markets could not ignore. He effectively shut commercial shipping through the Strait of Hormuz, the narrow corridor through which roughly 20% of the world's oil supply, nearly 20 million barrels per day, normally flows. In response, energy markets reacted with extraordinary speed. Brent crude surged from around $70 to nearly $120 a barrel, before stabilizing within a volatile $90–$110 range. At the same time, U.S. crude traded above $96. The International Energy Agency described the disruption as the largest supply shock in the modern history of the global oil market. Meanwhile, threats from the IRGC pushed speculation that oil could approach $200 per barrel. This forced policymakers and analysts, from Oxford Economics to major central banks, to reassess the economic implications. Because when an energy corridor of this scale is disrupted, the effects do not remain confined to oil. They ripple outward through inflation, monetary policy, and capital flows, quietly reshaping the environment that precious metals now inhabit. But the story does not stop at oil. The real shift begins when that energy shock moves through the wider economy. When crude surges from roughly $70 to over $120 per barrel, it quietly lifts the cost structure of everything from transportation to food production. Inflation expectations begin creeping higher again, even as growth starts losing momentum. The data already hints at that tension. The PCE inflation index, the Federal Reserve's preferred measure, is running near 2.8%. Meanwhile, U.S. GDP for the fourth quarter of 2025 was revised down sharply to just 4.7%, half the earlier estimate. The latest flash PMI readings point to the weakest business activity in nearly 10 months. and mortgage rates have climbed to about 6.3%. This creates an uncomfortable environment for policymakers. The Federal Reserve's policy rate currently sits between 3.5% and 3.75%. Markets assign more than a 95% probability that the Fed will hold rates steady at its upcoming meeting. Cutting rates risks fueling inflation already amplified by the oil shock. Raising them risks pushing a slowing economy closer to contraction. Economists have a name for this configuration: stagflation. A rare moment when growth weakens while prices remain stubbornly high. And historically, when economies drift into this territory, investors begin quietly reassessing where real stores of value might be found. And this is where the market begins to show something that should not normally happen under the textbook rules of finance. In ordinary conditions, a rising US dollar tends to suppress precious metals, because commodities priced in dollars become more expensive for global buyers. Yet right now, both assets are moving upward at the same time. The dollar index, DXY, recently closed near 156. It gained roughly 3.7% within a single month, its strongest level since late 2025. And yet gold continues to trade above $5,100 per ounce, after touching an all-time high near $5,602 on January 28. 1 year ago, gold was still around $2,984, meaning the metal has climbed roughly 74% in just 12 months. When the dollar and gold rally simultaneously, it usually signals something deeper than ordinary commodity trading. Historically, this combination appeared during the most unstable periods of the 1970s stagflation, when the breakdown of the Bretton Woods system and the OPEC oil embargo shook confidence in the global monetary order. What we may be witnessing today is a similar kind of fear trade. Capital is moving toward every perceived safe haven at once. Central banks from China, India, Turkey, and Poland continue accumulating gold reserves even at record prices. And when the largest institutional buyers behave this way, they are quietly revealing how they interpret the world that may be unfolding next. And this is exactly where the conversation shifts from gold to silver, because the asymmetry in this market becomes impossible to ignore. Silver closed near $84.44 on March 13th, before pulling back toward $80.54 the following day. An illustration of the volatility that has always defined this metal. Yet the larger picture tells a different story. Just 12 months ago, silver traded near $33 an ounce. Even after the recent correction from the January peak of $121.67, the metal has still more than doubled in a year. That kind of move is not random noise. It reflects a deeper repricing underway in the precious metals complex. Historically, silver has tended to follow gold during major monetary shifts, but often with greater magnitude. The gold-silver ratio, which once stretched to around 104 at the start of 2025, has compressed to roughly 62 today, moving closer to its long-term historical range between 40 and 60. What we are witnessing may be the early stages of that rebalancing. Silver is not simply reacting to gold. It is closing a valuation gap that had widened for years. And when markets begin correcting imbalances of that scale, the process rarely unfolds smoothly or quietly. But the real tension in the silver market is not simply about price. It is about availability. Beneath the daily volatility, the data inside the COMEX warehouse system reveals a structural pressure that most headline coverage never mentions. As of March 12, 2026, the amount of registered silver eligible for delivery stood at roughly 79 million ounces. Registered metal is not theoretical supply or paper exposure. It is the physical silver that can actually be delivered when a futures contract holder demands the metal. And that pool has been shrinking at a pace that does not fit the traditional rhythm of commodity markets. In January alone, more than 33 million ounces were withdrawn from registered vaults in a single week, representing roughly 1/4 of the entire deliverable category. Meanwhile, the broader COMEX system holds around 357 million ounces of total inventory, against approximately 577 million ounces of total inventory, against approximately 577 million ounces in paper claims, creating a paper-to-physical ratio of about 7.3 to 1. The coverage ratio has slipped near 13 to 14%, a level historically associated with delivery stress, At the same time, the market has slipped into backwardation, with spot prices trading above futures, signaling that buyers increasingly prefer metal today rather than promises for tomorrow. And when markets begin sending signals like that, the implications often extend far beyond the commodity itself. And this is where the story reaches its most important crossroads, because the signals coming from the physical market are beginning to diverge sharply from the behavior of the paper market. In the West, futures prices fluctuate daily as traders react to interest rates, currency strength, and geopolitical headlines. But in the East, the picture looks very different. Shanghai premiums have remained elevated between roughly 13% and 14%. Meanwhile, inventories on Chinese exchanges have fallen sharply, from about 559 tons in November 2025 to nearly 318 tons by February 2026, a decline of more than 40% in just 3 months. At the same time, China officially reclassified silver as a strategic material starting January 1, 2026, placing export licenses under tighter government control. That policy decision may prove more consequential than the short-term volatility in futures prices. Because once a commodity becomes strategically classified, supply flows rarely return to previous patterns. Meanwhile, the global silver market has now recorded 6 consecutive years of structural deficits, with cumulative shortages estimated near 820 million ounces, according to industry data. Add to that persistent demand from solar manufacturing and advanced electronics, and the supply equation becomes increasingly fragile. So the real question facing markets now is not simply where silver trades tomorrow, but which narrative ultimately proves stronger: the volatility of paper markets or the tightening reality of physical supply.